We continue to try and understand the internals of the GDP number. The headline number is now well known. Now we'll discuss what's been happening in terms of private consumption, government spending, and also fixed investment. Joining us on that discussion, Siddhartha Sanyal. He's Chief Economist for India at Barclays. Thanks so much, Siddhartha, for coming in. Also joining us on the phone line, Ms. Ashima Goyal, member of the Prime Minister's Economic Advisory Council. Very good morning to you, ma'am. Thanks so much for taking the time to speak to us. I'm actually going to put my first question across to you, ma'am. What did you make of the numbers? I know the headline was sort of in line with what most people were expecting, but within that headline there was an important change in terms of the government contribution to growth is coming off. Growth rates there are flattening out. On the other hand, fixed capital formation was looking a lot healthier this quarter.
Yes, I think that turnaround is very welcome. But it shows that there are constraints on the demand side. Consumption growth is still weak. And government expenditure will come down because they've been front-loading expenditure this year. And they are very keen on meeting their fiscal deficit targets. So government consumption is also going to be coming down. But I think the positives are that internationally, whenever export demand looks up, that's always good for the Indian economy. So we had constraints because of the impact of GST on manufacturing. But the high rate of growth of industry suggests that now Indian industry is in a position to take advantage of the rise in global demand. So that is one positive on the demand side. We should see exports picking up next quarter as the GST issues are sorted out.
Okay. Siddhartha, what was your sort of headline analysis into the number? Private consumption was one spot, and I wanted to speak about that in detail. Right. But what did you choose to focus on?
Well, broadly, it's a no surprise number. And these days, no surprise is a good thing because of late, the surprises had been pretty much one directional. Yeah. And if you see the overall take on the industry side, there had been some uptick in the tradable segment, like the manufacturing, mining, etc., which had a very big dip in the previous quarter, surprisingly big dip, just before the GST implementation. So to some extent, it was anticipated to some extent because GST gives a bit more advantage to the manufacturing sector, etc., and that's why they are possibly coming up now. Services softened a bit, but I won't be too worried just because of that, because a lot of it is government services driven. Yeah. So overall, the number is not too bad in my views. Okay. And we had always been maintaining this particular view that the continuous, the so-called 5-quarter drag, etc., it was not really a structural slowdown. You need to see that within those 5 quarters, there were at least 3 quarters which were marked by some kind of big structural move. There were multiple one-off moves, so to say. There was demonetization, there was GST implementation, all these things, rather than any major real growth driver getting derailed. Right. So our sense is that you have a gradual recovery still on going ahead in the next few quarters and should not be too worried.
Ms. Goyal, can I request you to sort of highlight or detail your sense of what's happening on the private consumption side? Compared to last quarter, also the growth numbers were, flat, slightly lower, in fact. Where do you think that weakness is coming from?
Yeah, well, let me start by disagreeing a little with the view expressed earlier. I think there's been a sort of structural slowdown in the Indian economy since 2011. And this is because there was a slowdown in export demand, a global growth slowdown. At the same time, we had high food inflation, so we went in for monetary fiscal tightening. The current account deficit was large because of gold imports and oil prices. So domestic demand was also contracting. And normally, if you're counter-cyclical, you compensate for a fall in global demand. And then we had that very fortuitous fall in oil prices in 2014. But because we're on the inflation targeting path and the monetary policy authorities took the view that this may not be sustainable, so there was space there for accommodation. But in any case, so we've had this slowdown, and we've seen this on the banking side also, very strong regulation, provisioning, asset recognition, etc. So you've had very slow credit growth ever since 2011, very slow private fixed capital formation since 2011. You can't say that there are no sort of structural issues here. But that said, I think now we are seeing a turnaround because the structural reforms, although there's not much monetary fiscal space now, but the structural reforms are going to improve even on the cost inflation side. GST should bring costs down. And also you'll see some recovery. I think consumption, your question about in demand because of global exports picking up, global demand picking up. And your question about consumption, I think consumption was the one sort of demand driver that we had going for us. And after 2 good monsoons, agricultural demand also is a little robust. But GST demonetisation before that really hit consumption. So if it's still weak, that means it's still recovering. It's not fully recovered. But going ahead, we should see consumption coming up, growing more strongly. And once consumption rises, you have excess capacity in durable consumer goods. And once this demand is getting, your capacity is getting utilized, you'll see investment beginning.
Okay. Ma'am, can I just ask you, to sort of elaborate on the point you were talking about in terms of limited space from here on, both on monetary, but most importantly on fiscal side. We've already started to see that weigh on the GDP numbers. Do you think at this juncture in the recovery, which is very early, perhaps there is an argument to be made to, not stick hard and fast to the fiscal deficit numbers and move towards fiscal expansion a little bit?
Yes, I think, in my view, there is space for some fiscal expansion, but I think the government is very committed to meeting numbers it has announced. So maybe at the next budget and the new FRBM that gives space for sort of 5% expansion deficit, and there are structural changes. And we are seeing major structural changes in the economy. But we'll have to see because maybe there's
Ms. Goyal, so sorry for interrupting you, but the phone line's not particularly good. So could we just ask you to repeat that bit on what you expect could be the position on fiscal deficit?
Yeah, I think that this government is very committed to meeting numbers it has announced. So there's not going to be, too much expansion in the fiscal deficit. If there is any slippage because of the changes in the tax regime. But with the next budget, you might see some relaxation on the path in line with the FRBM. But any relaxation is only going to be in line with the FRBM. And that gives, the new committee also gives a 0.5% GDP space to relax on the deficit path if there are structural changes. And there are major structural changes in the Indian economy. But nothing is certain just now because you have to see the numbers. It may be that GST, which expands the tax base, will really result by that time and show a considerable tax elasticity. The efforts at increasing direct taxation, even that tax base is expanding. So depending on what happens to tax revenue, if necessary, there will be 0.5% GDP space to relax on the fiscal consolidation path.
Okay. So that's sorry, ma'am, you were saying?
Yeah, but any stimulus is going to be marginal, it's going to be small. It's not like after the global financial crisis there was a 4% increase in fiscal deficit. That is not going to happen. That is why I say that the space, both monetary and fiscal, is somewhat limited.
Yeah.
But there is room for the structural reforms to play out positively, both in affecting demand and the cost.
Okay. Siddhartha, you want to come in? That doesn't look like there's fiscal space. I mean, even if there is, you go from 3.2 to 3.5, it's not like you're creating that spending space.
Right. It's a couple of things are pretty clear at this juncture, that there is a lot of uncertainty around the top line or revenue. Now, I'm saying uncertainty, not necessarily it's very bad. We still don't know whether it's good, bad, ugly, or even excellent. Right. We need to see a few more months' number. The new tax regime is way too new for us to make a clear judgment on that, and we need to give it a little more time. What is clear is instinctively this government is not really willing to go for big bang expenditure cut just to meet the numbers. So that's possibly where the hesitation comes from. But at the same time, they remain reasonably committed to meet the fiscal numbers as they have displayed over the last few years. So our sense is that there will be some kind of a real balancing act going ahead. And we won't be too surprised if the current year numbers ultimately come broadly in line with what the government had been talking about. Right.
So it's near about 3.2 somewhere.
Yeah, that's very
here or there.
That's very clearly their endeavor, and as that came out from Professor Goyal's comments as well.
But how will they, jump in here? We know, like you said, there's uncertainty, but how will they stick to those numbers? You're at 96% of the fiscal deficit target.
Where is the space?
Yeah,
well, if you see that particular aspect, I'll not be too worried just looking at that 96% number. If you just plot this particular chart, that what percentage got hit in which month, this is a very usual seasonality that in certain months they hit 96%, they cross 100%, and they pull it back later on in February and March. It's not ruled out.
But it isn't even just the percentage of spend. It is also the fact that, the percentage of what? You've postulated some indirect tax revenue,
right?
And you don't know whether you're going to get there this year,
right?
And I understand some economists. Yesterday we had Sanyal on, and she said, "Look, it's not a revenue problem; it's a cash flow problem, because we expect that all that tax is meant to accrue to the government, even if it's not being paid out right now because of implementation issues." But the fact is that we have no idea of whether, the base expansion has worked out to the extent that we expected it to.
Right.
And even if these are supposed to be tax-paying people, when will that money come in? So it's 96% of what?
So you are absolutely right, and I think it's a good way of putting it, that it's not necessarily a revenue problem; it's a cash flow problem. But the same cash flow issue, which is today a problem, 2-3 months down the line, can actually help you also. In which way? That the fiscal accounting is done on a cash accounting basis. So you have another about 4 months in hand to manage your accounts, and some bit of cash flow which was not possibly taking place in the months of July, August, September will possibly flow in over the period of the next 4 months
and give you the leeway
to spend more. At the same time, you have the leeway that you also adjust timing of some of your expenses and decide whether you release that particular money, whether on 20th of March or 2nd of April, and that actually helps you to manage the accounts. Yeah. So there are quite a few levers to pull at the end of the government also. So it's not necessarily just that strict maths, some bit of timing, adjustment, all these things. So I think a few things are clear, that, well, they are not denying the uncertainty on the revenue front, but instinctively they haven't succumbed to the idea of just point blank expenditure cut and stick to it. But at the same time, they are at heart, they are pretty much committed to this particular number. I think that's a reality, and we should accept
fair
that.
enough.
Yeah.
I have 2 quick questions for you, Ms. Goyal. One is to do with consumption, and I think what I'd like to understand better in terms of the impact on the next few quarters is how you expect the conflicting forces on consumption to play out. We've seen an upturn in the commodity cycle. We're seeing crude move up higher from here on. This morning we were talking to a crude expert who said that it might even hit 70 in the first quarter of next year as these production cuts continue. On the other hand, we've had a range of rate cuts on GST in the last couple of weeks, and that might help, maybe, if at all, in bringing back some of the consumption. So how do you see private consumption playing out in the next few quarters?
But I think that there were a lot of uncertainty, and that has negatively affected it. So I see it improving from here on. As you're saying, some price decreases could help, but also the recovery from the demonetisation, and so I would expect that consumption will improve. And India has always had a sort of healthy consumption ratio, in the sense we're not like China, where savings really dominates, but we're not like, say, some Latin American countries where there's hardly any savings. So we'll see savings ratios also growing as investment grows, as income grows. Okay. But the ratio of consumption should come back to above 60% of GDP. It's lower than that now.
Okay, and my second question was on gross fixed capital investment. That numbers looked, showed some improvement in the quarter gone by. How much more can we expect it to improve from here on, based on your assessment of the contributing factors to that number?
Yes, as I said, as consumption and export demand increases and private fixed investment has been low since 2011 with some peak in some recovery in 2015. So as all these uncertainties decrease and as capacity is utilized, we should see the private investment cycle beginning. And public sector investment is also sort of, they've been trying to raise expenditure and they have, but they don't have, it's at the most 1% of GDP they were able to raise it. So private investment has to rise. And I think we should see some improvement there. I think already there's a lot of interest on the private side in this low-income housing. So the other factor is that the government is using innovative financial instruments or leveraging its expenditure to kickstart private. So you should see crowding in on that front also. The government's direct expenditure will not be so much, but the incentives that it can give, the warranties, etc., might help kickstart more private investment.
Siddhartha, you had a point.
I think on the consumption side, there's a very interesting story out there. Consumption, as Professor Goyal also pointed out, is a bigger chunk of the Indian economy, the mainstay that actually determines growth to a great extent. Now, if you see this particular chunk is generally reasonably stable. It moves in the range of 7-8% more often than not. Surprisingly, to an extent counterintuitively, if you go back to a few quarters, say Q4 of 2016, that's particularly the demonetization quarter. You know what the growth rate of private consumption in that particular quarter was? 11%. So all quarters 7-8%, one quarter 11%. And then possibly now it's open to interpretation why it shot up all of a sudden in the demonetization quarter. I'm not getting into that.
I know why. Yeah. All the people rushed to malls that night to buy all those expensive bags and everything.
No, but from our GDP analysis at the moment, more importantly, is possibly we are paying the price of that after that. Okay. So one quarter you shot to 11%, and after that you cannot breach the bar of mid 6% and things like that, and it's around there. What makes me a little worried is the next quarter's print will be on the base of that 11% for private consumption. Really so I don't know. In general, there is a bit of an improvement in terms of genuine and the trend demand in consumption, but that kind of front loading or back loading which had happened in Q4 2016, we have to pay a price of that base also. Wow. So it's a tricky game there.
And on private investment, sorry, I know you have a question. Just quick one. Have we bottomed out on private investment?
Well, maybe, because the bottom was quite a nasty bottom and stayed there for a pretty long time. So our sense is that you might see some uptick, but at the same time, I'll not just turn overtly bullish on that. That might be a slow process, because the level of confidence in the industry after a few quarters of bad numbers and all, it takes a bit of time to come back. So the typical sentiment on the part of industry in terms of capex is that if I'll join the party a few months rather too late, rather than joining it even few weeks early, right? So they might actually want to see some bit of uptick in numbers, hard numbers in their demand, and then only put money in capex. So it might be a path of improvement, but still a very, very gradual one.
So that I just remember a conversation that we used to have with a bunch of local, I'm talking about Bombay-based small businesses immediately post GST, and all of them said that July was virtually a no-go month. Right now, despite an extremely weak or on zero activity, so to say, July, if we've had this number, a lot of people believe that the O&D quarter, October, November, December quarter, would be remarkably better than the number that we've shown of 6.1 in the July, August, September quarter. Is that as simple, or would you presume that the numbers for O&D and Jan, Feb, March could be remarkably better than what we posted?
Well, that's the debate which we just discussed in a way that in terms of trend activity, there is a clear uptick there. That after July or maybe early part of August, there is a very clear improvement in trend activity, so-called green shoots, you can say in terms of activity. But in terms of numbers, remember, you have to fight against the base of 11% private consumption in the next quarter. So that's the balancing act.
Yeah, not
But
consumption. Okay, fair. Thank you.
Yeah.
I think we have Ms. Goyal back, ma'am. I'm really sorry we're having trouble with your line, but I wanted to get you back for one specific question on the farm sector. What do you make of the fact that farm sector growth was slow? I know there was some base built in there. Is there something to worry about? Also, is that going to then have a bearing on consumption? I think one of the economists who was with us yesterday was wondering whether there is a link between the weaker consumption and the farm sector numbers.
Yes, that is true. There is a base effect here. So overall, I think crops, the production is not too bad in many crops. There is a increase in absolute numbers. And there are signs, for example, fast-moving consumer goods companies are finding a lot of demand in rural areas, are finding support there. So, and I think that we are seeing a period where there is some improvement. In the past, monetary policy has really been constrained by food price inflation, but we've seen a very steady increase in procurement prices. Recently, there's some volatility in pulse production and prices, but the volatility in production is not as much as in prices. So they're not sort of giving up on producing pulses. So I think that is despite the fall in prices. So I think that would moderate inflation going forward. And there are other improvements in marketing, and it's very difficult to get firm data on this because agriculture sector is so huge and spread out over so many states. But it seems that there is some improvement on the supply side in agriculture, which should restrain food inflation and consumer demand also because of two good monsoons. Maybe the farm loan waivers will help, but there seem to be signs of good demand in rural areas also.
Okay. Just a last question from me to both you and to Siddhartha. So we've got now 2 quarters numbers. So we had GVA, speaking of GVA, 5.6 and 6.1. Where would you suspect we'll settle for the year? Doesn't look like we'll make it to the 7 mark. A little tough to make it to that 7 mark for the full year.
Yeah, I would expect about 6.5%. Some increase in the next 2 quarters, but the year average will turn out to be below 7.
So that's
something very similar. We do talk in terms of the GDP number, and our GDP number for the full year, financial year, is 6.8%. Okay. So in a way, very similar.
So not a spectacular recovery year.
No, obviously not. But at the same time, if you, the second half fiscal year numbers will look better, but the first half drag is very, very strong.
Yeah, and I think the point that both of you were making is that from here on, any recovery will have to happen on its own might, right? There is no fiscal support, monetary support coming in, so it has to be the underlying strength of the economy that has to come back. Yeah. Not the way you look at it?
No, I think that's correct, and that's possibly the correct way to grow also. Because if you just bother about one particular quarter or one particular year, you might cut rates a lot, put a lot of liquidity, but it's kind of growing on steroids, not growing on your merit, and in a way, potentially it's borrowing a bit of growth from future.
Yeah.
You don't do it when you try to have a very sustainable long-term growth. I think it's fine if you actually create a lot of space in terms of stability for the economy. At the same time, you have put in a lot of efforts in terms of formalizing the economy. Going ahead, you possibly put in your efforts in terms of bringing some kind of logical conclusion in terms of a lot of administrative reforms, especially as you come closer to elections, 1.5 years down the line. And still the economy should benefit quite a bit going ahead because of these factors and grow at a decent pace.
One word answer, RBI rate cut on the 6th?
No? Our baseline scenario is no.
No.
But they turn a bit more balanced in their stance in our view, and increasingly turning more data dependent. So the excess hawkishness of H1 2017, we think they have turned a lot more balanced now.
Let me ask Ms. Goyal for a one-word answer if she's still with us. Ma'am, do you expect that the RBI, or let me put it this way, do you think that the RBI should cut rates when it meets on December 6th or not?
No, we have an independent MPC and they should take a decision freely. That is in the best interest of the economy. But in my view, whatever little space there is in monetary and fiscal policy should be used. No, and because there are clear signs of a demand slowdown in the economy.
All right, we'll leave it there. Thank you very much to both of you for joining us this morning.